Hey, good morning, options traders. Welcome, everyone. And I've had a number of traders asking about the average true range, also known as the ATR. And it's come up a lot just because of all the volatility in the market. And the ATR is a different measure of volatility, a little bit different from the VIX. Now, sometimes traders use it as an alternative measure to the VIX, but there are some drawbacks. So you need to understand exactly what it is you're looking at if you're using the ATR. So what exactly is it? Well, the ATR was developed by J. Wells Wilder back in the late 70s, and this is the same guy, if that name sounds familiar, who developed Relative Strength Index, RSI, Parabolic SAR, Average Directional Index, or the ADX. Now, interestingly, the ADX also uses the ATR. But the average true range, again, is a measure of volatility. But like all volatility measures, there are limitations to them. But the reason that Wilder created this, you have to understand he was a commodities trader that had a lot more volatility. You had limit up, limit down days. And the close-to-close method fails to capture those gaps. So think about it. If you have a stock that closes at 100 today, gaps up to 110 on the opening bell, trades down to 90 during the day, and closes back at 100, obviously there was a lot of volatility. But the close-to-close method would show that there's none. It would say it closed at 100 on one day and closed at 100 the next. So that's what the average true range was trying to capture, all of these potential gaps. So the average true range, what it does is it takes the greatest of three calculations. This is really the heart of the ATR and what's probably the most important to understand. So calculation number one, you're going to take the current high minus the current low. So whatever the highest trade was from today and whatever the lowest trade was, you subtract those out and you say, okay, that gives me some number. Let's write that off to the side, let's record it, but let's compare it to another calculation. We're going to look at today's high, by current, I mean that's our current candle, and we're going to subtract off yesterday's close, the previous close. Now the calculation takes what's called the absolute value, that's a mathematical term that just says, how far is it away from zero? In other words, don't worry if it's negative, we're just going to pretend it's positive. So that's going to capture any gap ups. If we have a really big gap up, we're going to say, what was the high of this day and compare it to yesterday's close. So we're going to write that number down, and then we're going to look at a third calc. We're going to take the current low from today's candle and subtract off the previous close. And again, if that comes up to be a negative number, we're going to record it as positive. So that's what's called the absolute value. So again, the absolute value is really just saying how far are you from zero. So it's always a positive number. So if we have in one calculation, if it turns out to be 100 minus 102, and we jot down minus 102 as one of our numbers, you can't do that. You need to record it as 2. And if you think about it, it makes sense because volatility is non-directional. We're saying I don't care if it's up 2 or down 2, it's just a change of 2. So that will help to explain why we're always looking at the absolute value in that second and third calculation. So before we consider some of the limitations of the ATR, let's take a little closer look at the calculations. So here's calculation 1. And for right now, let's just focus on the green candle. Let's say this is today's candle after the close. Well, here's the high trade and here's the low trade. So it's very simple. We're just going to take the high minus the low, and that's going to give us some number. Now, if it happens to be a red candle, don't let that throw you. We're not looking at the opening and the closing, which are the tops and bottoms of these boxes. We're looking at the highs and the lows. So if it's a red candle, exactly the same calculation, high minus the low. So notice that the high trade absolutely must be a greater number than the low. That's why we don't take the absolute value here. Just the high minus the low, we're going to record that. Then we're going to move to calculation 2. And this will happen if we get a big gap up. So we're going to take the current high from today's candle. So here's our high trade, and we're going to compare that to the previous close. Remember, anytime we're doing a comparison to a previous candle, it's always going to be based on the close. And that's because if you had to pick one trade from that day that was best representative of the entire day, it would be the closing price. So in a red candle, we are looking at the box. The top of the box is the opening trade, the bottom of the box is the close. And because the close is below the open, that's what's making this box red. So it's this number right here, that's our closing price. So we're going to take this number minus this number. So whatever that distance is, it's going to give us a dollar number, and we're going to record it. We're going to write that number down. And then we're going to take a look at calculation 3, which will help us to capture gap downs. So it says to take the current low minus the previous close. So if this is today's candle, we're going to say what was the current low, and that's right there. And we're going to compare it to yesterday's close. So on a green candle, the top of the box is the close. The bottom is the opening, and because the close is above the open, that's why the candle is green. So this is our closing price right here, and we're going to take this number minus this number. So notice that it's just going to be this distance right here. Whatever that is in terms of dollars, that's what we're going to write down. So in this instance, notice that we would get a negative number. This might be 100 down here. This might be 105 up here. And if we take 100 minus 105, it's a negative number, but you know now to record that as positive 5. So when you get all three of those numbers jotted down, you're just going to take the largest of those three. Now, without going into the details, I do it in the technical analysis course and show it in an Excel spreadsheet, but basically what you're doing is looking at a running average. We're just going to take the highest of these three numbers on every single day, and we're going to do some type of a smoothing or an averaging effect, and that's what you're looking at on the ADX. So while the average true range does capture more of the gaps than traditional volatility, there are some limitations of it. And probably the biggest is that the ATR shows only the absolute values. So your normal volatility calculations, such as the VIX, show levels in percentages. So you might see that it's a 20% volatility or a 30% volatility. It's as a percentage. And I think everybody knows that if we have a 20% volatility stock compared to a 30%, that the 30% has more price variation. All we have to do is look at which one has the biggest percentage. Well, you can't do that with ATR. And that's because ATR shows absolute values in dollars. So that means higher price stocks will have higher ATRs, and lower price stocks will have lower ATRs. So it's not good for comparisons between stocks, but yet traders will do it. And they'll say, hey, did you see stock A has got this massive ATR compared to stock B? Well, stock A is a $4,000 stock and stock B is a $20 stock. Yes, it's going to have a higher ATR. So you don't really want to use it to make comparisons across stocks. Instead, what you want to do is to look for relative changes. Is it becoming a much bigger spike, or is it moving down, this ATR? So you can look at it as a confirming signal with other indicators. Maybe you're seeing a technical breakout and saying, are we also getting a move in the ATR as well? And that might give you a little more confidence that yes, we are seeing more volatility in this breakout. So let's jump over to E-Trade and see how to put it on your platform. All right, so now into the E-Trade platform, come up here to Studies, drop down here to All Studies, and right over here under the A's, right there is the average true range, or ATR. Click there. Now the default is 14 periods. I said this was developed by J. Wells Wilder, and that was just what he chose. I also said there's an averaging method that's going on here, and that's what he's doing. He's looking back over the last 14 calculations, let's say the last 14 trading days. So we could change that, but for the most part, I would leave the defaults. You can change the color if you wish, choose Save, and there is your ATR. So you can see during coronavirus, it was pushing $15 averages. Now, is that big or small? Well, at that time, the price of the index was down around 220 or so. So that's really the way you would need to look at it. But really the better way is to say these were typical averages through here, and now look at this. Can we have some confidence in this breakdown? Yes, just because the average volatility, those gap up, gap down days are much, much bigger in terms of dollars. And conversely, can we have some confidence coming out of this rally? Look at how quickly the ATR was sinking. So that's really a better way to use the ATR, but I hope it at least gives you a little better understanding of what it is because I've had some traders asking about it. It is a very popular indicator, especially for those of you trying to measure volatility. So that's your brief overview of the ATR. So for anyone who'd like to learn more about the art and science of technical analysis, please check out the brand new technical analysis course at optionsatoz.com. You can also instant message me right here in Facebook.